Hey everyone, welcome back. We are going to talk today about a subject that I'm getting lots of people messaging me about. So at this point in time, I don't know, this is I think March 20th, 21st, something like that, and 2019. And so the government has started various different stimulus programs, etc. And a bunch of people are asking about hyperinflation. So there's people talking in Europe about, hey, the concerns of the euro crashing. There's concerns about the dollar having issues. We've had quite a bit of volatility in terms of currencies. And what's really apparent to me, based on the conspiracy theory stuff and different videos and comments, etc., is the people who are discussing this do not understand the mechanics behind inflation, and in particular hyperinflation. So I want to take a little bit of time to explain how this works and to therefore give you some sort of a framework around which you can understand whether it's likely for this to happen, okay? So the first thing to understand is that it's really define what is inflation, okay? And there is a little bit of a misnomer that comes about due to kind of two different schools of economic thought, all right? So if you were to study the Austrian School of Economics, you will find that they define money printing as inflation. All right. Now, from the perspective of internal consistency, that's okay because they can use their own definitions and apply them. But nobody else in the world refers to money printing as inflation. And you can go through the arguments that they have for reconciling this. But in the real world of how people think, they think of inflation in terms not of money printing, but in terms of prices going up. That is to say, purchasing power of your dollars going down. Okay, this is the first thing that's important. So that's the context around which we're looking. And contrary to what many people suggest, it is not accurate that money printing equates to purchasing power decrease and price increase, all right? And the reason for that is that prices are set, as we know in classical economic theory, by the intersection of supply and demand, all right? And there's complex mechanisms behind that, but that's where we end up with prices. So prices do not necessarily increase because there is more money in the system if the supply of goods and services is kept within balance. And we're going to talk about that in a little bit more detail in a minute, but before we do that, we're going to go back and we're going to look at some other examples of first of all, where there hasn't been inflation, and then some cases where there has been inflation, in particular hyperinflation, what drove that, and what that tells us about what is likely to happen at this point in time, okay? If we look back to 2008, they started, well, maybe let's, before we talk about that, let's talk about what's going on right now. So there was $1.5 trillion approximately brought out by the Fed to service, to inject it into the repo market in order to free up liquidity, okay? So that's some money. They announced quantitative easing, $750 billion in that regard, and the government has announced it's about $1 trillion stimulus. We're talking about the US government right now. Just for the purposes of this conversation, we won't talk about Canada, we won't talk about Europe, we won't talk about Australia, etc. We'll just focus on the US. The underlying dynamics will have some similarities, but you're gonna figure out the principles behind it, which should help you to figure out, will that apply in some other area of the world, okay? So this is the money that thus far, there's been some other stimulus dollars, so approximately that's what we're looking at so far. And there was this nonsense comment made about, oh hey, Medicare for all, it seems too expensive, but we can just drop $1.5 trillion into the repo markets. Well, that's not money that just vanishes, okay? That's not money that's spent into the system. Those are short-term loans that are provided to provide liquidity to allow lending, okay? So this is very important. And we're gonna go back and look at where a lot of people thought there would be inflation. And in fact, somebody sent me some commentary yesterday about, hey, it's a mystery why quantitative easing didn't cause inflation. That's total nonsense. It is not a mystery. It is very easy to understand. And in fact, it was predicted, if you want to go and read, macroeconomist Bill Mitchell has a blog, and he specifically at the time said, hey, there will not be inflation caused by this, and here's why, all right? So let's start with quantitative easing, because that's a portion of what's happening, and that's a portion of what will likely happen. We'll probably get more quantitative easing over time. And why that has not resulted in consumer price inflation. And I think this is another important principle to understand. You have to understand that you can have localized inflation, right? So for example, right now, okay, there is an inflation in the price of masks. A number of months ago, you could buy masks for about 9 cents. They went up to about $3, all right? This is a massive inflation in that price. And this is fundamentally based on supply and demand, right? It makes perfect sense. You can see the price of oil has obviously gone way down, right? You have quantitative easing creates financial asset inflation, but does not typically translate to inflation in the consumer price index. And the consumer price index is the measure that the government uses to figure out if there's inflation and how much inflation there is. And those numbers have been very low. They've been sub 2%. 2% is the Federal Reserve inflation target, and so they haven't even met that. However, there's a lot of reasons to believe that the CBI is very much off. And you can see that just in your own anecdotal experience, all right? Just pay attention to, do things that you bought 10 years ago cost much less, and if so, how much less than they do today, all right? You would expect at, let's say, 1.6, 1.7% inflation, that 20 or 10 years later, you would have about a 20% price increase, right? And you can just start looking at, across your life, how have your costs adjusted, okay? CBI, you can go and read some analysis on it about why it is not a very good measure of inflation, and people will argue that inflation is much higher than is reflected in CBI. And I tend to agree with that just based on anecdotal evidence, and they'll give you explanations for why it is that there's built-in incentives for CBI not to accurately reflect inflation, whether those incentives are actually drivers for why it is. The bottom line is that the real experience that people have is that prices of the cost of living is greater than should be predicted by those figures. And we see this, for example, in the cost of going to eat out at restaurants, which arguably has been increased due to rising minimum wages and other factors as well. Okay, so looking at that context, there's things that aren't measured there that really are important parts of people's cost of living, but they don't get reflected. So anyway, the bottom line is CBI measures haven't shown a lot of inflation. They're a measure, but probably there's more inflation than that. That being said, there certainly hasn't been hyperinflation, there hasn't been extreme inflation, and why is that? Well, the reason for that is because even if we take the argument that the supply of money expanding drives prices up, which there is not a direct correlation, again, we're going to talk about that, quantitative easing does not increase the supply of money, okay? So to understand this, you need to understand that there's fundamentally two types of money, okay? And yes, you can get M0, M1, M2, M3, M4, and so on. This is not that. This is more the underlying, it's about understanding it from the perspective of looking at balance sheets and double entry accounting, okay? So if you want to kind of read more about this, again, I'd recommend you look up the blog of Dr. Bill Mitchell. He gives some lengthy descriptions. He's fairly dense, it's heavy reading, but he's got some great resources, and there's a good community of people around that who are interesting. And I'll do some videos in the future about modern money theory, and he's an advocate for modern money, how it's misinterpreted by the media and politics, and potentially negative consequences of that, but that's for another topic. For today, the important thing to understand is that the source of money comes from fundamentally two places, all right? The first is federal government deficit spending, okay? This is where they print money into existence. And the important thing that happens here is that money becomes an asset without a corresponding liability on the balance sheet of the private sector, okay? So the money supply has expanded in that respect. Now, of course, there is a corresponding loss in the sense for the federal government, but the money supply has increased. And this is what they call high-powered money, okay? This is kind of the base which we then leverage up. And this brings us to the second type of money, which they call low-powered money. I use the term credit. And so credit is created by private banks, okay? So private banks leverage high-powered money in order to create low-powered money or credit, which further expands the money supply. And if you look at the total supply, it is by far bigger and more influenced by the credit markets than it is by the high-powered money. It's an order of magnitude more, okay? So that's going to be an important context as we go forward. And this helps us to understand, if we look back to 2008, what happened, all right, in 2008, kind of leading up to there, we had a massive expansion in the credit markets. That money was primarily driven by the housing bubble and put into real estate. We saw real estate prices inflate dramatically, right? And then when we had a massive number of defaults, we saw that deflate, and as a result, we saw virtually all financial assets, as well as others, go down simultaneously. So real estate, bonds, stocks, all went down at the same time. To some extent, even gold did. And this makes sense in a deflationary environment, okay? So the supply of money decreased, driven by this credit bubble popping, okay? What came after that was they did stimulus, large government stimulus, and we're going to talk in a minute about how that plays into today, as well as the introduction of quantitative easing, and they poured trillions of dollars in by quantitative easing. Now, what I frequently heard from people at that point in time, and is highly inaccurate from the lens of understanding of how most people think of it, is people would say quantitative easing is money printing. Quantitative easing is not money printing in the sense that it increases the supply of financial assets within the system, okay? And to understand this, you need to look at balance sheets, in particular bank balance sheets, all right? This is very, very important. So if you look, when a bank gives a loan, what happens? Well, the bank basically inflates their balance sheet by creating an asset, which is the debt that's owed to them, and a liability, which is the money that is given to the person. Now, this asset and liability cancel each other out, okay? So although the balance sheet has expanded, the net worth has not increased. Whereas if you were to receive money from the government, your net worth does increase, all right? That's the difference between this high-powered money, low-powered money thing. And it's very, very important to pay attention to what's going on here, okay? When you do quantitative easing, what is quantitative easing? It is not money printing. What it is banks own government securities, okay? The central bank, the Federal Reserve in this case, buys those government bonds, government securities, from the banks, swapping those government bonds for bank reserves. Bank reserves is essentially just cash, okay? Not necessarily physical cash, but cash on their balance sheet, all right? The reason, supposedly, that they're trying to do that is to stimulate lending, all right? This is nonsense. It doesn't stimulate lending because lending is not reserves constrained, meaning that bank reserves are not the defining factor for whether banks give loans or not. This is a total misunderstanding which causes a bunch of problems. Banks are capital constrained, and there's a difference between capital adequacy ratios and reserve ratios, okay? So a lot of people think there's something called, fractional reserve lending, okay? And it's based on this idea that people make deposits and they leverage up your deposit and, multiplies this money. It's called the money multiplier effect, and it's not true, okay? Because of the fact that they don't multiply bank reserves, they multiply bank capital. And bank capital is essentially, we're going to oversimplify it here, but it is retained earnings plus shareholder equity, okay? So these things more or less form the capital which banks use they'll multiply it, absolutely. But that is not the same as the deposits, which might be in the form of bank reserves, may be made up largely of deposits. Okay, so a bank does not need deposits, at least if it's a part of the central banking system, it does not need deposits in order to make loans because it can borrow through the overnight market to cover the difference, provided it has enough bank capital. So the thing that drives bank loans is demand from creditworthy borrowers, okay? And so if you have no creditworthy borrowers or the creditworthy borrowers aren't creating demand for loans, then you're not going to do any lending, and bank capital. Both of those two things are required, and in the absence of those, you won't have lending, okay? If you have those, it doesn't really matter if you have reserves because you can make up the reserve requirements through either the overnight market or the discount window, okay? So this is an important thing to understand in terms of the mechanics of how banking works. So, okay, they go and they say, all right, we're going to provide liquidity to the banks, and we're going to do that by we're going to buy these government securities because government securities aren't liquid, right? And we're going to swap them for bank reserves. The thing that happens here, if you look at the bank balance sheet, the net worth of the bank, the actual net financial assets have not changed in this scenario. There is no more money than there was before. The only difference is that instead of the money being somewhat illiquid, it's now liquid, okay? So if you have a GIC, a term deposit, a government bond, etc., it's worth $100,000 and somebody comes and gives you $100,000 for it, you don't have more money now. The difference is that the form of the money has converted. That is what quantitative easing does, okay? There are two consequences of this within the market when this happens. The first thing that happens is you decrease the supply of government bonds in the system that are being exchanged, okay? The resulting, if you can just pay attention to this, supply and demand, there's fewer bonds, but the demand is the same. In fact, the demand in a sense has grown, which results in a decrease in the bond quantity because the federal or the central bank is buying it, right? That's going to drive up bond prices, which is what we saw. At the same time, what's going to happen is you're going to have, that money is going to have to go somewhere. The bank is going to say, okay, what are we going to do with these bank reserves? So they're going to invest them. That money's going to go into the stock market primarily, right? It could go a bunch of places in theory, but the stock market is the other obvious market aside from the bond market where money can go. And hence you will see stock prices go up. So this is where we talked, I think in one of the other videos, about correlation of assets. We were talking about with respect to crypto in that particular case, but you saw in a deflationary environment, both bonds and stocks went down. There was a credit risk, so there was a chance of default on those bonds. And if you have although in theory the volatility of stocks is supposed to be greater than the volatility of bonds, and so the downside is supposed to be lower, this is the theory, but if you're buying corporate bonds and the business is going bankrupt, then more or less they're both going to zero is the concern, right? And so hence that there's these converge on each other in terms of what's going to happen to them. So we had that in kind of 2008, early 2009. Then we had this injection of capital, which took the form of purchasing these government securities, converting those to reducing the supply. That pushed up the supply of bonds, but that money needed to go somewhere else. It went into stocks, and stocks went up at the same time, okay? So that was the mechanics of what happened. Now notice that it's very logical that this does not result, yes, it results in inflation of the financial assets because there's a scarcity, there's a reduction of the financial assets that are available, and therefore financial assets go up. But that does not push consumer prices up, okay? And the reason is because that money doesn't have an easy mechanism to flow back into the system. There is like some degree of trickle over because of the fact that, okay, when these assets go up, that increases profits. Various different shareholders now have more money, they can borrow against those assets, etc. So there's some sort of a trickle over, but it's dramatically lower than the amount of capital that's injected into the markets, I guess it's the markets, through quantitative easing. Okay, so that's like the first thing to understand, is quantitative easing has a very minimal effect on actual consumer price inflation, okay? Very, very important to understand that. And similar deal, they did this one point, so we have $750 billion of quantitative easing that have been announced. We've got $1.5 trillion of money going into the repo markets, similar sort of thing, okay? That money, that's not the same as money printing in the sense that this money is just going into the system and inflating consumer prices, okay? Very, very important to realize that. Where do we go from there? Well, from there, and by the way, we had a similar situation that we have going on right now, which is at the same time as you had this, yes, slight boost to inflationary forces, right? You also had simultaneous deflationary forces because you had rising unemployment. And this brings us to the next part of how pricing and inflation works, okay? If you were a business owner, probably the people who are watching this, probably a bunch of them are entrepreneurs, you can just ask yourself, why would I raise my prices, okay? There's typically gonna be two drivers for why you're gonna raise your prices. The first one is your costs go up, right? And we see this in, for example, the restaurant industry, where minimum wages have gone up, and we see the price of food going up, right? This makes perfect sense because you have to cover that off somehow, okay? If your costs go up, you're gonna charge more. We see it in the price at the pump when we're talking about oil prices go up, even after hedging, etc. There's some additional costs, certainly that trickle into the system, and therefore you're gonna end up charging more for it. Very logical, right? The second is if your available productive capacity is is less than the demand that you have. So if you're a restaurant, for example, or a hotel or something like that, and say you're at 60% capacity, and you suddenly go up to 80% capacity, are you going to increase your prices? Typically the answer is no. You're going to absorb your available capacity before you start to increase your prices, all right? There might be an argument that, okay, the market is attempting to increase profitability, so you may increase prices on that basis, but that's mitigated to a large extent by competition, and so because of that, you're generally not going to end up with much price increase without the supply being overwhelmed by the demand, okay? So these two things are the primary drivers behind what's going on. And what we saw in 2008 was we saw very low unemployment. So the tendency is, rather than paying more, you're going to hire people to increase, rather than raising your prices in order to meet the demand, what you're going to do is you're going to hire people. And when you hire people, that's going to increase your productive capacity. That capacity is going to allow you to fulfill on the demand, and you're going to grow that way. And that's going to mitigate the price increases. Now, as you reach full employment, that's going to change, right? When you're at full employment, now all of a sudden you have to start paying people more. That's going to drive up your costs. You're going to have, if you have the demand for it, you can increase your costs, provided that it's makes sense from a perspective of competition, and off you go, okay? So hopefully that all makes sense in terms of the mechanics of what's driving things here. And you're going to have a similar situation probably right now, right? We have massive deflationary forces at work. So we're in an interesting situation where there could be some inflation. There likely won't be hyperinflation. We'll get to that in a second. But there also could be deflation. So there's some degree of uncertainty depending on what plays out. If there's no stimulus, then we're almost certainly in massive deflation, okay? And this is very easy to see because there's going to be less spending. There's less spending because people aren't making money because people are staying at home, right? If people are staying at home and they're not working, they don't have money, they're not going to spend money. If they don't spend money, that means that businesses are not going to have enough revenue. If they don't have enough revenue, that means that they're going to have to lay people off, they're going to have to shut down operations, they're going to default on debts. This is going to have a ripple effect in terms of some sort of a cycle, okay? So that's the potential consequence of what can go on the deflationary side. And then if you add some, you inject capital in there in the form, particularly in this case, we're talking about government spending. Okay, government deficit spending does actually increase the supply of money in the system. So they just announced, about $1 trillion that is going to go into the system. That will increase the supply. 100%, that will increase the supply. It's going to be mitigated by this. And so the question is how much, where's that balance, and how much more do they do is, the other side of it. Okay, so we see high-powered money is going to go in there. This, in theory, allows us to increase, we are going to be in a potential situation where if there is sufficient bank capital and if there is demand from creditworthy borrowers, that we could increase the size of the credit markets, and that could further have an inflationary effect, which goes potentially directly into the price of consumer goods, again, provided that we don't have the ability to absorb that additional demand through the unused productive capacity, okay? So I hope that kind of makes enough sense. Let's take from there, which kind of explains loosely what's going on with inflation, and go to the subject of hyperinflation, okay? Hyperinflation is not a term defined in economics, at least that I've seen it anywhere. What some people will say is they'll say hyperinflation is inflation on steroids. I would go so far as to say that hyperinflation, really the defining factor is not a specific rate of inflation, but the point at which people lose confidence in the money, and therefore the velocity of spending increases dramatically because people are spending the money very quickly because they're afraid it's not going to be worth more tomorrow, right? Or not worth much tomorrow. And we saw this, for example, in the Weimar Republic in Germany around 1920. We've seen this in Zimbabwe. We've seen this in Yugoslavia. We saw it in a bunch of these different places. This is kind of the fear that people are pandering. And it's really, really, really important to understand the dynamics behind what drives that, okay? That is not simply a case of government printing money, okay? That is almost exclusively the result of a combination of two factors, and we will probably have one of those factors which, does raise a little bit of specter of inflation, okay? But the other factor is virtually certainly not there. So let's go back and let's look at what happened in Germany when they experienced hyperinflation in the early 20s, okay? What happened was you had massive debt that Germany had to the Allied nations post World War I, and they were making these debt payments. Okay, that was quite hard on the German economy and the German people. Okay, so they had to make this payment. What happened as a result was there ended up being a variety of strikes. When those strikes happened, that decreased the productive output of the country. Okay, you can just start thinking, okay, we're producing goods, we're producing money, we're making things, we're making our debt payments. Now all of a sudden that drops off, and it was exacerbated by the actions of some of these other Western European countries towards Germany at the time. It amplified that, right? So you had a massive drop off in production. This provides a scarcity of goods, right? Scarcity of goods is not good. That scarcity of goods was accompanied by the fact that those debt payments continued. Now, if those debt payments had been denominated in German marks, then it might not have been so bad. But it was foreign debt, so I don't know what currency specifically it was in at the time, but let's just use, for example, that it was British pounds. Okay, so you have British pounds there, and you have German marks, right? So what's going on? The Germans, to address this problem, start printing more money. Okay, and let's just say the ratio, for the simple sake of example, was 4 to 1 at the time. Okay, 4 marks to 1 pound. So, and let's say there's $100 billion of debt. Doesn't matter what the number is, it's the concept that is important. So I print 100 million marks to make a payment. Well, now there's more marks, and the relative value of those marks relative to pounds goes down a little bit. So now I maybe need to print 5 marks for every $1. So I print my next 100 million, right? And then it goes down a little bit more. So now I need to, it's 6 to 1, and I print 100 million more and more and more. And the more that I print, the less value those marks have in order to repay that debt, which means that in turn, I have to print more marks to make up that debt. This is a very, very important thing. Like it's horrendous for the system, but it wouldn't have happened if it wasn't for this foreign denominated debt, okay? Something similar happened in Zimbabwe. In Zimbabwe, what ended up happening was it was a largely agricultural farming society in terms of their output, and they ended up confiscating land from the white people who were running it at the time, okay? Unfortunately, when this happened and they gave it over, the people they gave it over to didn't know how to run those farms productively. The result was that their farming output decreased dramatically. At the same time, they had foreign denominated debt. So you just think about this. Again, the output goes down, right? This isn't good. Therefore, we need to make that up somehow in order to continue making our payments and not default. So the way that we do that is we start printing money. But the more of that money we print, the less value that money has. And so we have to print ever more. And this creates this cycle of rapid hyperinflation, where you'll have, the money devalues by hundreds, thousands of % over the course of a very short period of time, all right? Now, if you study virtually every case of hyperinflation, we're not talking about, okay, the Turkish currency a couple years ago declined dramatically. If you go and look at Malaysia, the Malaysian ringgit, kind of following the 1MDB scandal coming out, declined a bunch. This is not hyperinflation, okay? Yes, it's not good. You had a collapse in the currency, and it was great to go on vacation to those places at that point in time because prices dropped a bunch on a relative basis. But this is not extreme hyperinflation, okay? So in cases of actual extreme hyperinflation, such as Yugoslavia and whatever it was, the 80s or something, such as the Weimar Republic, such as Zimbabwe, etc., this combination of two factors tends to play together pretty much universally, okay? So let's look at the situation in the US now. There is a drop of productive capacity, right? Goldman Sachs, I just read some report. Now, I don't necessarily trust their reports because they had forecast, I think it was a 4% decrease in GDP for this quarter. They've revised it to negative 24%. So obviously their numbers were highly inaccurate before. It makes it less likely to trust them in the future, in my view. But anyway, that being said, a 24% decrease in GDP is a massive decrease. It has never before been experienced in the history of the country. The largest ever quarterly drop was 10%, okay? So very, very major. You're having much, much less productive output, much less capacity, and as a result, or not capacity, but just output. And that's going to tend, you just look, supply and demand, right? If the demand is the same, but the supply of goods is lower, the price of goods is going to tend to go up, all right? The difference in the case of the US is that you have a situation where there isn't foreign denominated debt. So the US debt is denominated in US currency, okay? So, for example, China holds whatever it is, a couple $1 trillion of US debt. Well, that's held in US dollars. So they have the ability to print $2 trillion of US debt and pay off that, or not debt, of money, and pay off that debt. This is within their power, okay? And if they do that, will that create some amount of inflation? Yeah, and then whether it translates onto the consumer prices is another thing, but certainly the relative value of the money goes down, right? That's just, you have more of it, so the relative value is going to go down somewhat. If you did, there's about 22 trillion or something in federal debt. If they printed it all, that would go down more. How much that is, that's going to depend on the confidence of the market, the demand for the dollar, what's going on in terms of other factors such as, lost my train of thought. Anyway, so the whole point is that, the total size of the monetary system, right? So if you have, $200 trillion and you're adding 20 trillion, that's much less significant than if you have 40 trillion and you're adding 20 trillion, right? So bottom line is that there's certain proportions and you could kind of see how that plays out over time, et cetera. But the bottom line is there is an actual increase, and that increase does have some effect, for sure. It potentially could be magnified by a scarcity of goods, right? And so we could see, it's possible, that we see a bump in inflation. What does that work out to? Maybe 10%, who knows? Not necessarily, because again, we have these mitigating, contravening factors in the form of deflationary forces that are kind of working in opposition to it. So it's a little bit uncertain how that will play out. But what we can be certain about is you don't have the ingredient of this foreign denominated debt that as you print more, the money becomes worth less, and therefore you need to print more, and it creates this vicious cycle which results in hyperinflation. So all of that to say, it is highly improbable that the US currency hyperinflates. Could inflate, entirely possible, but this extreme hyperinflation, very, very, very unlikely. Like the mechanics behind it, if you understand, and hopefully this gave you a good understanding of how exactly the structure of it works behind there. If you understand those mechanics, you see that it's very, very unlikely that that would happen. Now, maybe there would be some other extreme event that would result in loss of confidence in the dollar and other things. But this brings us to the final point, and then I'll leave you with this. It's a fairly long video. Is you have to measure based on what, right? And a lot of people thought that we would be at a place of extreme inflation by now already because we've had this rapidly growing debt, right? Basically, the debt has doubled every 10 years or so, the US federal debt I'm talking about. And honestly, probably it will double faster in this particular cycle. What has happened in the economy right now means, okay, they've pumped, or they're pumping $1 trillion in. We will print money, we will do deficit spending as we have never seen before. It is highly, highly likely. The political incentives combined with the environment mean that in order to mitigate those negative factors, and it's very politically expedient to mitigate those factors, mean you will highly likely produce enormous amounts of government deficit spending. I think we'll be triple what they did in 2008 before we're done. Maybe higher, it's hard to say, but 2 trillion very likely is going to be required, I would say at minimum, okay? Wouldn't surprise me if it was much higher. So you're gonna have that combined with the fact that, hey look, if you have a 24% drop in GDP, what happens to your tax revenues? Your tax revenues are cratering, okay? So tax revenue is dropping at the same time as spending is radically going up. You're gonna have a $5 trillion deficit this, like in this next year, probably, like something like that, whatever, whether it's exactly that number, who knows, but in that margin, right? There will be a huge deficit as we have not seen before, and it will probably carry on for quite some period of time. So I would expect we could be at 40 trillion in national debt within the next 5 years. This is not an unreasonable expectation. However, everybody else is doing the same thing, right? So Europe is kind of in this situation where it's, more or less a binary option, right? It's like, okay, they have to do, well, or maybe there's three options, right? They allow the Eurozone to collapse, or they say, okay, great, we're going to print an enormous amount of money, or we're gonna go and we're gonna say, all right, one example is we break things up, etc., where we go into like a deep dark recession, right? These are kind of the three options that I can see there. And so what's gonna happen? Well, in all likelihood, they'll do massive amounts of government spending in order to try and prevent this. And so that's gonna have a similar effect as in the US. And as a result, on a relative basis, the US is really not in so much of a worse place from a decrease in the value of money standpoint. And that will probably be the case. It will be the case in Canada, in Australia, in UK, in Scandinavia, probably in Japan, and just across the board, this is likely to be what we will see. And so the bottom line of that is just to answer this important question that some people are having and people are messaging me about, and there's kind of this, I don't know, I would call it fear mongering going on. The likelihood of hyperinflation at this point in time in the US is extremely low. It is highly unlikely that that will happen. Like I said, there may be some inflation. It's, there's a reasonable expectation that that could happen, but definitely nothing super extreme. So I hope that gives you a good framework for understanding. If you have questions, please put them in the comments. Subscribe if you like the video, like it, share it. That helps us out. And I will look forward to seeing you guys on the next video.